Hello everyone, as you can notice from the title below, this video is going to be about valuation of JD.com. However, if you're keeping up with my videos, you'll know that I've already covered this in the in-depth analysis video that I did on the company. So why am I doing it again? Well, this is because I made a huge mistake, and one of the viewers was kind enough to highlight this to me a couple of hours ago. And I wanted to quickly clarify everything and correct myself so that I'm not spreading any misinformation. So let's hit it out. Updated DCF model. Like always, this model is full of assumptions that are made by me, and I will be going through these assumptions in a minute. However, I will also link down this Google spreadsheet in the description below, so you can just pull it out, make a copy of it, and if you're interested, you can change the number according to whatever you feel is more reasonable. So for the revenue, I'm projecting it for the next 5 years, and for the year 2021, I'm taking the growth as 28%. This is because of the unofficial guidance that JD.com's management provided in the Q1 earnings call for this year. So you guys can go and listen to the earnings call, and you'll figure out why I took this number. Going forward, I'm decreasing it a bit at 25%, and then 20% and 15% then forth. This is like, again, you can't expect the company to keep up with its own growth, right? So it's better to be more reasonable, conservative, and decrease it over time. 15% at the end is quite reasonable, in my opinion. Moving on to the net profit, right? And we see the net profit margins. I'm taking it at 2.2% for 2021. And this, if you guys know, it's quite low from the 2020 numbers, and the reason I've already discussed in the in-depth analysis video, so I won't be going through it again. It's slightly higher from the 2019 numbers because during the Q1 earnings, the JD.com management talked about how there is an increase in the home appliances sale, and that was improving their margins. Going forward as well, I expect the margins to increase because of the long-term trend where more and more brands are attaching to JD.com, and they are getting a full source of services from JD.com and not just their marketplace. And these services include marketing done by JD.com, their supply chain management, and all those things, which are more profitable for JD.com, and hence I see their margins increasing. I think 4% is somewhere their margins would go to, and it's reasonable to take this kind of numbers. You can adjust if you don't feel comfortable with this. Then going on, I have not changed much about the calculation of WACC. So all these numbers over here you see are pulled off from their financial reports for 2020. And the risk-free rate are Chinese treasury bond, a 10-year bond. And then beta is from the Yahoo Finances. And the market return 10% is just a reasonable number. If you see S&P 500, the average return is about 7-8%, right? So 10% is quite reasonable. Then the market cap. The market cap is the total number of outstanding shares multiplied by stock price, which I've taken as 280 Hong Kong dollars. Then we have the required rate of return, which was calculated out of all the numbers that we keyed in. And then we can use this numbers to calculate the WACC. Now WACC is the number we'll be using to discount the future cash flow to find the present value of the stock. So to find the present value, we have to first find out the future cash flow. Now, if you see the past few years free cash flow rate, right, it's fluctuating quite a bit. So just to take a number, I'm taking 70% as the free cash flow rate for my projections going forward. So 70% of the net earnings, net profits, will become the free cash flow for the company. And I'm taking the perpetual growth rate at 4%, and this is something that I believe is okay for China. And looking at where JD would be growing as well, they are still quite limited to China right now, except for some Southeast Asian countries, but they have the potential to expand furthermore. All right, so after this we can discount the future cash flow for its present value, and then add them up to find the total value of the entire company. Then we can divide it by the outstanding shares, which will bring the fair value, my calculated value of JD.com at $302, 2 Hong Kong dollars. Now this is the Hong Kong dollar price, and then if you want to get the price of the US listed ADS, you just have to multiply this, convert it to US dollar and multiply it by 2, because each ADS is twice the head shares. And if you want to take the the difference between the current price, you'll get it to be about 7.38%. So yeah, and now it's okay to buy JD.com in my opinion. However, for the valuation and DCF model, right, in my opinion, what I have figured out, it's very easy to manipulate the numbers according to what is your bias, right? If you want to increase the end number that you get, you can just manipulate a few here and there, increase 5% from the revenue growth or the net profit margins, increase the free cash flow rate, and you'll get to the number you want to get. So it is very very subjective in a way. That's why I'm providing this Google spreadsheet to you. However, you look at it in a way that if this is the value of the company that you are okay to pay for JD.com, right, then you should be expecting this amount of growth in the coming years, and this amount of net margins in the coming years, and the free cash flow rate again. So these are your expectations now that gives you a fair value of the company here. And if the company fails to perform at these expected growth numbers, then you will see the share price decreasing, and you would have to readjust your valuation at that point of time. Hence, it's always good to take the numbers lower, or the other thing you can do is adjust the numbers to the current share price, and then you see if you believe that whatever numbers you come up with are reasonable as where the market is heading, or the industry is heading, where the country is going, and how the company is set to gain the market share going into the future. So that is another approach you can take with DCF model, and that is my opinion for you guys. Rest is up to you. Always go on and do your own tinkering with the numbers so you understand them better, and at the same time you can help me by finding any mistakes that I do, like how David just a couple of hours ago messaged, and I could really correct my mistakes over here. So yeah, that's about it for today's video. I would like to thank David again for highlighting my mistake, and yeah, thanks. See you in the next one. Ciao.